Good afternoon, everyone. Thank you for coming out. It's actually a beautiful day in the city of brotherly love. And this is a special treat. This panel is a special group for a lot of reasons, both professionally, but also for their willingness to travel to Philadelphia in late winter. Fortunately for you, you missed the snow, but it's a long way to come to be with us, and we're very grateful. And I think it'd be very difficult to put together a better panel to talk about the state of takeover law in the UK and the Cadbury case in particular. I'm going to introduce everyone briefly. I won't pretend to do justice by all their credentials. And I'll start to my immediate left is Scott Simpson, who is an American lawyer, but a partner at Skadden, Arps, but I guess we're still allowed to say Arps, right? The Skadden firm. But Scott chose, I think, a generation ago when he was partners with a distinguished member of our audience, to go to London and to focus his practice more internationally on mergers and acquisitions. And Scott has been a partner in Skadden's London office, has handled some of the most fascinating cross-border deals, not simply in the UK, but throughout the world, including some, didn't you do the cool Gucci? Were you involved in the Gucci thing? I mean, you got all kinds of things. If you're into consumer, where you want to know Scott, Scott is now global head of mergers and acquisitions for Skadden, and soon will be intergalactic once they go that way. But he's really a gem, and has a great perspective, having been steeped in American takeover law before he went to concentrate his practice in the EU. Scott was also instrumental in getting our guest to join us. Sarah Jones who's to Scott's left, made the sort of opposite trek in her career. She went from she's a partner at Clifford Chance, represented a small company called Kraft, which used to be part of an even smaller international tobacco powdered mac and cheese company before it went independent. But Sarah represented Kraft in the actual Cadbury deal, and she's represented Kraft and other major companies in many multi-billion-dollar transactions. And she's been based in New York since 2006, but went back to her homeland to help Kraft acquire the maker of dairy milk. Continuing this sort of migrational trend, to Sarah's left is Creighton CONDON, who's a partner in Shearman and Sterling. Practiced most of his career on this side of the pond, which he was born, right, and grew up, but decided to go to London, and is now the European managing partner for Shearman and Sterling. And he represented Cadbury. So our American lawyer here went abroad, represented the English target company, and our English American-based lawyer represented the American-based acquirer. Creighton has represented big companies like Viacom, Citigroup on other major M&A transactions. And I give a shout out, he's also a graduate of the University of Pennsylvania in 1978, his BA. He wasn't able to do well enough at undergrad to get into Penn Law School and had to go to Columbia, but it's good to have him back, and he's distinguished himself nonetheless. The real expert on the panel, though, is our final guest, and that's Noel Hinton. Noel is going to tell you a lot of times, I heard it many times, he doesn't know anything about company law, but he knows everything there is to know about UK takeover law. Seriously, Noel has been a regulator in high-level positions in the UK for a long time. He spent an early part of his career working at the Bank of England, but in 1984, he was seconded from the bank to the takeover panel for 2 years. And in 86 was invited to become just the third permanent member of the staff of the Takeover panel. And in 1991 was appointed the Deputy Director General of the panel. As I understand it, being a former staff guy myself, I worked in the executive branch of government, this is basically the senior professional staffer at the Takeover panel, and Noel served in that capacity from 1991 until he retired in the last couple of years. But you really have no better historical perspective on the real operations of the UK Takeover panel than from Noel, and we're very grateful to him for taking his time to come over. And so without further ado, I'm going to turn it over to Sarah.
Well, let me just stop for a second and acknowledge that this is a meeting of the seminar that Vice Chancellor Strine and I teach. The people who are not in suits are probably members of that class, and a number of you still owe us paper topics. So be sure to be in touch with me in the next couple of days if that is true.
Well, and
if
I will
you
also,
are one of them.
I will also make one other thing. In the true spirit of things, we were suggesting we should get together and prepare. And I said, if we want to get together and prepare, Manchester United is playing Chelsea. And see, we went to the pub across the street, and we watched the match. If anybody knows the final score, please shout it out. We left with 20 minutes left, showing our dedication. I think Noel was impressed that in America there was a bar at 4 o'clock in the afternoon filled with Americans all watching the game. 2 to 1.
Yes!
And I only say that because I favor Arsenal, so that's why I'll care. Scott's partner is the chairman of the Chelsea Football Club.
So I have to root against him.
But without further ado, the powdered mac and cheese versus dairy milk struggle. Sarah?
Yes, we thought it might be helpful as a bit of background just to run through some of the timetable. We're probably not going to spend too much time on this because we want to get to the substantive debate. In particular, I'm not going to spend any time... Thank you. In particular, I'm not going to spend any time on this first slide since I think that everybody in this room will understand who the parties are and a bit of the background. I also want to say as I run through this, something that Leo didn't mention is that Creighton's firm actually, and Creighton particularly, represented Cadbury on the transaction, so I'm delighted to be in the room with him, and I'm hoping that he will chip in with commentary from Cadbury's perspective. So the deal played out in a number of parts. The first was obviously the initial approach. The initial approach, private, between Arjen Rosenfeld and Roger Carr, chairman of Cadbury. On 7th of September, Kraft put out a public announcement through what's called in the UK a bear hug letter, immediately rejected by Cadbury, which was not unexpected. Now, this is a tactic to put out a bear hug. It's not something that is typically seen or was required by the Takeover Code. It is a decision that a bidder can make for a number of reasons. One of them would be if the bid is unwelcome, but you think it might be received more favorably by shareholders. As you put it out there, get the debate going. Under the code, whilst you're contemplating an offer, there's also a very strict requirement for confidentiality. So Kraft was only able to speak to a very restricted number of people outside its advisors, including in particular potential providers of finance. So putting the offer out there enables Kraft then to talk to a wider circle of people about the offer.
One thing I would say is that the bear hug isn't necessarily a widely used technique in the UK, as I understand it, but given that Cadbury is being advised by both U.S. and UK bidders, and that the initial meeting with the chairman was perfunctory, I guess was the way I described it, it was clear to us that it was just a setup for the next steps, which in this case was a bear hug. Whether it was a bear hug or an actual public, proposal was, some speculation on our side, but we expected something to come of the meeting, just because it was not approached as necessarily a friendly session so much as setting up the aftermath.
Well, wait a minute. So do tell.
I wonder for the students if you could describe what a bear hug is. We get the sort of picture, but
yeah,
sure.
and give us a picture, both of your perspective of what this first meeting was about and your various perspectives, because I think that's interesting. Was what you're saying from the target side?
From the target side, it was a very short meeting.
And it was from Kraft's side too.
And it was very short and highly scripted. It was not the sort of conversation of CEO to CEO, get together, does this make sense? Should we think about it? Let's talk about it, and maybe we can talk again, some later date. It was deliver the message, highly scripted, seemed almost uncomfortable from the buyer side to our chairman. So it clearly, from our perspective, was just a first step in a process.
And it was.
So you're saying you agree with that, Sarah?
I wasn't there, but it was a first step in a process, yeah.
Is that because you did not expect any receptivity?
I think we did not.
But it could have been different, Creighton. Really, the chairman was really, if he had just gotten an actual kind of teddy bear hug at the first meeting, it might have gone down different?
It might have been if the price was, a lot more attractive.
So it's worth pausing a bit on the next, which is that the statement of a possible offer was accompanied by a statement by Kraft that it believed that post the takeover, it would be able to protect UK jobs and keep a UK factory open. And I might just read, it's very short, that statement, because I think that statement really was the catalyst and formed the basis for a lot of the furore that erupted further down the line. The statement says that our plans contemplate that the UK would be a net beneficiary in terms of jobs. For example, we believe that we would be in a position to continue to operate the Somerdale factory, which is currently planned to be closed, and to invest in Bourneville, another factory, thereby preserving UK manufacturing jobs. And so I just wanted to read that because later on you're going to see that a lot came out of that statement, and a lot of the fallout really was triggered by that statement of belief on Kraft's part.
Could I just ask a question, because obviously that garnered a lot of attention right out of the box, but then more and more so as events transpired. What prompted that statement other than good politics, good PR, and what was the basis for it? What was the factual basis for Kraft thinking they could make that statement?
I think the statement was made because Kraft wanted to be able to give an example of a benefit of scale. Scale can achieve really good things. For example, the scale of Kraft's operations and its need to produce chocolate across the world may mean that it can assist in maintaining factories that might otherwise be closed on a Cadbury standalone business. The basis on which that statement was made is quite clearly a statement of belief. Kraft had at that point had no access and didn't have until after the bid was recommended any access to confidential information at Cadbury about the state of the factory, the state of the closure of the factory. And I think one of the things that Leo wanted us to point out is in a UK bid context, access to due diligence is severely limited, either as a matter of practicality, because in a hostile deal, who's going to open their doors and give you access to information, but also there's a rule of the code which says that any information provided to one bidder must be provided to a competing bidder, even if that bidder is hostile.
Well, let me just set the stage, because I'm not sure everybody quite, as Sarah and Creighton, I think we need to give people some context. As I understand it, correct me if I'm wrong, the Somerdale plant of Cadbury has some significance, that this was a fairly venerable manufacturing facility. I think it would be good to hear from Noel and you, Sarah, a little bit about Cadbury. I mean, Cadbury's not just any company. There's a certain emotional feeling about it, but it's my understanding that the decision had been taken by Chairman Carr and the Cadbury board to shut the Somerdale plant down. So they had already, as Cadbury, taken that decision, and they were moving the jobs to a lower wage country, Poland. Kraft comes in, and as part of its bid move, in a regime, and let's get to the regime, right, where you cannot take frustrating action, and one of Kraft's first statements is, well, hey, we might be able to reverse this decision. We actually could be, as I take it there, better for the UK. We might actually be able to keep the jobs there. Have I got the political context right?
Yeah.
And is Somerdale a pretty venerable facility for Cadbury?
Yes.
By the way, is venerable good or bad for the facility?
Well, my sense is, right, it was regarded as one of the key parts of the Cadbury institution, right? And that they
Not
had
as much as Bourneville.
not
but, yeah.
Bourneville was even Bourneville's like little Cadbury land, right? I mean,
Yeah.
where
Yeah,
they,
Bourneville is a
Bourneville's the
brand of
equivalent to
Cadbury.
Hershey here in Pennsylvania. So the original Quaker town that Cadbury formed as a company town, the same way that Hershey, in the same Quaker tradition, did that in Hershey.
and as I understand it, in Bourneville, Cadbury has things like built youth facilities for sport and other kinds of things. And Cadbury, I take it, in the UK was regarded as a high-quality employer that was very community-oriented, right?
Yeah.
But what's curious to me about this particular move, and we probably shouldn't belabor it too much because we'll keep coming back to it, but in a system where the government is not supposed to be able to intervene in a protectionist fashion, the way, for instance, the French in the sort of the strategic yogurt case was able to intervene. This is a system, and we'll hear more about it as the panel discussion continues, but this is a system that's supposed to be devoid, more or less, of government intervention, and yet in that system, this is a bidder that decides to make a blatantly political move very, very early on, and Sarah, we promised Sarah that she wouldn't necessarily have to be the defender of each and every aspect, but it is a curious sort of early move in a system that's not really supposed to throw up political.
Right, and part of why we're setting the framework, I think, right, for Sarah and everybody is, this is not just any company, right? And I'm assuming, Sarah, part of why Kraft was sensitive to it is it may be a non-frustration regime, but it's not just any company, and you're trying to create an environment where you're going to go in there and actually, if you get the company, be an effective operator, right?
Yeah.
Was it also seen as making this move, warming the cockles of the hearts of the institutions or giving them the ability to say to Roger Carr, well, look, they're going to take care of the people?
Well, look, there's undeniably a PR aspect to it, right? It's a positive message, but that's not the reason it was made.
Okay.
I mean, it was made genuinely and in good faith and with the belief that they would be able to support both the new Polish factory and the existing Somerdale factory. Okay, so as the next step, Cadbury made a request to the UK Takeover panel to issue a put up or shut up request to Kraft, and Noel can leap in. But the question of a put up or shut up is the ability of the target to say to the Takeover panel, you need to get we can't be under siege for too long. You need to get the bidder to either say that it's going to make a firm offer or that it's not going to make an offer. The idea behind it is that you balance the sort of siege of the target with the interests of the shareholders in hearing enough about a bid to decide on its merits. Under the current regime, and we'll come on later to how this might change following the Cadbury deal, it is something that Cadbury needed to request of the Takeover panel. It's not automatic. And the duration of the time for put up or shut up is something which is in discretion of the panel, and it's something which the parties both made representations to on the panel, obviously on Kraft's side for it to be as long as possible, and on the Cadbury side for it to be as short as possible.
Well, we had a very compelling argument at the end of the day, and that was that we wanted to make sure we could put our defense document on the table before Christmas and not get caught up in everyone's holiday season. And I think we shortened the time frame a little bit because of that, but it was really it's one of these highly tactical decisions as to when you ask for the put up and shut up and then the negotiation with the panel. From a U.S. lawyer's perspective, the whole panel process is quite unique because there's so much discretion in the panel as it relates to these time frames, and there's a lot of discretion as to what you're allowed to say and not say, and the bankers are the primary interface with the panel, not lawyers. And so it's quite a different system when you get down to it on a practical
Well,
basis.
we glossed over something on the first slide a little bit just to make sure everybody's, because I'm not sure everybody's quite as chocolate-oriented as they used to be. It's meant that Hershey was rumored, and Hershey's somebody that's kind of, around here, we're pretty familiar with that. It's not all that far away from here, as a potential partner for Cadbury. What is the calculus, Creighton, in calling for the shorter put up and shut up in terms of your ability to perhaps do some, pit Kraft against somebody or get somebody else in? How did you guys evaluate that?
Well, at the end of the day, if you look at the timeframes under the UK system, it was several weeks in before we asked for the put up and shut up. The panel came back and gave us a time frame, which I think was another six weeks before Kraft had to launch. And then there's another 28 days before you have to post your documents, and then a period after that. So the time frame is quite lengthy even once you start the process. And so from our perspective, either we were going to get to a Hershey deal or some other alternative, or we weren't, but the time frame was unlikely to be the driver of it.
If I could ask just for, again, for comparison with the U.S., put up or shut up is not part of the U.S. stance. How often is that request made as part of the UK stance?
Well, the rule actually came in 2004 in more precise terms than it had been in the code before. And I would say since 2004, the number of times the panel's been asked to put up or shut up notice out has increased year on year. I don't know what the practitioners think, but that was my impression. A lot of the statements from the panel are exactly along the lines that we've been hearing. There's been a request from the offeree that put up or shut up should take place. There's been a negotiation, a discussion with the panel. A ruling has been given, neither side has appealed it, and the offeror knows it must do the necessary by a particular date. And that's been happening, as I say, more and more, I think. I'll go into the history later, perhaps, when we talk about where we're going with that rule. Sorry, where the panel's going with that rule.
It is interesting because in the States, obviously, the dynamic, bidders would love nothing more than the target to declare game on, game over in a certain period of time. It's usually the target who's trying to drag it out and the bidder who's trying to accelerate the time frame.
Okay.
Can I just, sorry, just Creighton, just coming back to, so was Cadbury at a point where they knew they were going to be, that they were going to trade, and this was all about price early on? Did Cadbury know that it was going to need Hershey's help under a relatively quick time frame? How does that factor into
I think the answer is no. They didn't assume that they were going to trade. I think they obviously knew that if Kraft was really prepared to pay up, they would trade because there would be a price at which they wouldn't be able to.
By trade, you mean
sell?
Be sold.
The company would be sold.
Yes, the company would be sold, but they still had to. They were dealing with Warren Buffett as a shareholder, who, depending on what your point of view is as to what Warren Buffett's agenda was in making this statement, he was out quite publicly saying, don't overpay for this asset. Now, that may have been to put some discipline and manage expectations of Cadbury shareholders, or that may have been, a true statement of belief, maybe both. But it did introduce an element of doubt as to how much Kraft was prepared to pay. And given that dynamic, and there was a shareholder vote in the original structure. There's a requirement that Kraft shareholders approve. So, having Warren Buffett as a negative vote would have been quite significant. So that was part of the calculus as to, do we let this thing drag out, or do we just, try and get the process started and see where it goes to? But there's at least a chance that this deal doesn't happen because of that dynamic.
Casey, do you have a...
There was a vote because in the original, the consideration for the deal was a mixture of shares and cash. And under the original deal, you'd have needed a vote because it would have, the shares required to be issued would have represented more than 20% of Kraft's existing share capital.
No, and I should have said this before. We encourage questions and comments throughout. So students, any of the thing, if you've got a question, we want it to be, the panel's interested in it being as interactive as we can get it, so.
If I could ask, did Buffett have somebody on the board?
No.
He wasn't represented at all?
No.
Because the impression, certainly, if you read in the newspaper account, was that he was hostile to the deal, that he wasn't playing.
It is interesting, and actually at this first early stage, all he came out and said was, don't overpay. which was actually probably helpful for Kraft, because it's helping to manage Cadbury's expectations. You know, if the major shareholder comes out and says don't overpay, you can bet that Kraft isn't going to be stupid. The more interesting announcement was the one he made nearer the end of the offer timetable, which is on the slide, which said that he intended to vote no at the proposal unless there was a compelling, unless they could really show shareholder value for Kraft. And certainly amongst our constituency on the Kraft side, there were differing views about whether he was intending to be helpful to Kraft or not. It doesn't sound very helpful on the one hand, but on the other, the point at which he made that final statement was, as I say, getting right to the point under the code timetable where Kraft had to make its final offer. And so again, you could say it's telling Kraft to be sensible. It's also, if the offer fails for any reason, you could look at it as giving Kraft really an excuse, an elegant way out. You know, if Warren Buffett doesn't approve, then it's no bad thing if the deal doesn't happen. So there were definitely two schools of thought about it.
I mean, the other interesting thing, obviously, from our perspective was in the restructured proposal at the end, it was restructured with additional cash. They sold some assets, raised some additional cash, reduced the amount of stock that was required so that there was no longer a shareholder vote required, which we assume was not coincidental.
That was definitely... Right.
Yes, he did.
He liked pizza. Yeah, he did. He was critical of that transaction.
He liked pizza. He wasn't wild about chocolate. Yeah.
And obviously the fact that the ultimate mix meant we didn't need to get a shareholder vote was obviously helpful, because it meant that it was really an academic discussion about what Mr. Buffett thought about the deal, as opposed to actually having to have him vote for.
So just to compare a little bit to the U.S. system, which, as Leo said, the targets can play for time. The UK system has this notion that a target company, should not be under siege. And the whole concept of a put up or shut up and the whole concept of a defined timetable is designed to limit the amount of time that a target is under siege. And I guess it sounds like, Creighton, that this was a situation where tactically, early on, you were seeking to take advantage of the fact that you could keep them on a tight time frame.
Yes.
Because tactically, you had maybe Buffett on your side and maybe some constraints. And potentially, as the case continues and as the noose tightened around Cadbury, maybe the notion of revisiting a delay in the timetable is something that...
Yeah, well, and the other tactical consideration is the longer you wait and the longer the whole process takes, as you get closer to the end and it's becomes more apparent that you don't have a good alternative, then obviously the leverage shifts in terms of what the bidder ultimately thinks they need to put on the table at the end in order to get the deal. So there is a concept that you don't want to let this drag indefinitely and find yourself with nothing at the end, and quite obviously nothing at the end, and have a lower price.
Right, and so ultimately the takeover panel ruled a 6-week put up or shut up, which I think we both probably thought that was something of a victory. It could have been shorter, it could have been longer. In the end, it was 9 weeks from our original announcement date, and we thought that was not bad in the circumstances. Just for the background, for the later discussions, on the 25th of September, the Business Secretary of State, Lord Mandelson, made a statement that foreign ownership of British companies could be a disadvantage to the country over a long period of time, and the fact that he came out and publicly said that really also started to help spark the debate in the UK about reform and whether this takeover was a good thing.
He's not the first politician to have said that, and I dare say he won't be the last.
So moving on to the next stage, which is what we call the formal offer stage. So Kraft had 6 weeks to put up or shut up. On the 9th of November, Kraft formalised its offer and made the offer on the same terms as in the original announcement. I think that was our strategy, play long term. We weren't going to put an increase in then. I suppose that wasn't...
It was not a surprise.
Not a surprise. In green, you'll see that under the code, as soon as you make your formal offer, you're absolutely bound to proceed now. So Kraft, there wasn't any way that Kraft could back out. and was obliged to post its offer documentation within 28 days. You'll see that above that it notes that on the 9th of November, Kraft entered into a loan facility. One of the key features of the code is at the point at which you announce the firm offer, you must have financing in place, unconditional financing and committed funds. Again, that's a particular feature of the UK, but that's one of the reasons if you're a bidder that you want any put up and shut up period to be as long as possible, especially if you're raising a lot of debt. You need to have the time to negotiate that and find your lenders.
And it's a very distinguishing feature of the UK system that you have to have committed funds. There's no financing conditions. In the US, you can launch a tender offer and it can be conditioned on effectively anything, so long as it's not deemed to be illusory. You can certainly have a condition on financing and board approval and other things that are not within your control to satisfy.
And
there's not even anything like a material adverse effect either, is there? Right?
That's correct.
Incredibly high hurdle.
Am I wrong, or probably the financing documents which are binding in the UK are shorter than the non-binding 85-page commitment letters in the US that are not binding?
I mean, it might also be worth pointing out that someone has to confirm that the cash is there, and the panel reserves the right, in the event of the cash not being there, to go to the person who confirmed. So you have to make sure the funds are there. Back in the 80s, it did happen once or twice. We looked to people to provide the money which their client had not provided. I think since then, once we had done that once or twice, people make sure the money's there.
And that's typically the investment bankers who confirm.
So it's basically a system where, I mean, this is a blind bid in the sense there's no non-public information changing hands. And once the put up or shut up comes, when you put up, you have firm financing and no out.
The only real outs that you'll be able to invoke are antitrust, clearance, and if there's a shareholder vote.
But like if the Bourneville plant burned down in a fire, you would still have to buy.
You would, I mean, I say those are the only two conditions. Actually, if you look at the offer document, there are 5 pages of conditions, most of which the panel would never allow you to invoke. And one of those is a material adverse change. But as Nigel says, Noel says, sorry, it would be, it's unimaginable really that the panel would allow you to pull in that circumstance, right?
Yeah.
I put on the 13th of November because it was a sort of, we thought, Cadbury Council wrote to us to tell us that US shareholders held more than 40% of Cadbury shares. That was relevant because if Cadbury shareholders in the US held less than 40%, then we could come within the Tier 2 exemptions to the SEC rules. We were convinced that from what we had, that US shareholders held less than 40%, and we got this letter, and we thought
from
this
Creighton.
was... From this man. And we were convinced that this was the first really hostile move and that this is where we were going to start the battle. But in retrospect, we found out that actually you thought you were being helpful.
Well, I'm not sure we thought we were being helpful, to be honest.
But if I could ask Isaac and Roy, were you guys in on this deal at all?
Apologize for that. We'd been holders of Cadbury's for many years and had viewed their confectionery business as really a crown jewel, and were even more enthusiastic about the company after it spun off its beverage unit, in large part because it could have been both a platform for consolidation or be folded into a consolidator, in this case Kraft. We were worried and were on the sidelines and not investors in either company until late September, I believe, and only after Buffett had made his statements, which I think over time we'd interpreted as not being helpful, not intending to be helpful either, but protective of himself, and candidly protective of Kraft shareholders. The biggest risk we viewed was overpayment, and by his forceful expression, and then the restructuring of the deal to be more of a cash deal, we viewed it as a risk that was palatable for us. We also didn't like the pizza sale, not so much because it wasn't right to sell pizza, but it had a very low tax basis, and the after cash, it was a very high cost way of getting the cash for the deal that was necessary. And we'd purchased a very large stake in Kraft and continue to own it. We're one of the company's largest holders, and have a very good relationship with the company and think this is one of the best deals of all time, actually. The benefits of it are not apt to be seen for some time still. So it's a 2013 synergy story, not a 2011 synergy story. But the synergies are absolutely there, and the platform is incredible.
We bought stock of Cadbury after their letter was published, and probably peaked at 3% of Cadbury. We have 0.9, so not bad. Thanks to the Takeover panel, we were disclosing it every day as we were transacting the stock. We ran the position long Kraft because we shared a relatively constructive view on the transaction. We also didn't like the pizza deal. We probably thought we were buying off Nestle as a potential interloper.
So did we, by the way.
It wasn't that.
But so we did think this was a premier asset, a very, very good category, and for Kraft, a total transformation transaction. So from the arbitrage perspective, those things tend to get pretty high prices in the end of the buffet, and not circumstances inspired and have that kind of a price.
Can I ask you a question? Because part of when we were on the Cadbury side, and I represented Cadbury for 20 years, the issue for Cadbury once they spun off the beverage business, they frankly expected ultimately to be sold because they thought it was the right thing to do for shareholder value, but they knew that the beverage business was a poison pill to being taken over. So once they spun it off. And they were going through a significant restructuring, and Kraft's timing, I have to say, was perfect in the sense that Cadbury had done all the work in restructuring that business, and there was a tremendous upside, which was part of the debate, I think, when the takeover really got going. Was that a common perception in the market that there was? Did that resonate at all with shareholders in terms of a valuation point or not?
I think from our perspective, we were a little more skeptical about some of the benefits of the restructuring. And frankly, I think Cadbury's last couple of reports may have indicated this. We thought Cadbury was stuck in the channel. So we thought it was opportunistic from a market cyclical perspective, meaning that this was October of '09. So the market, the capital markets have just gone through a true trauma, and to the extent that someone like a Hershey or even a KKR, kind of look at a transaction like this, the financing markets just were not as robust as they might be. So I think we thought that was kind of the Kraft's opportunity was more of a capital markets timing bet than it was a bet on the quality of Cadbury's restructuring.
Just for the students, just so you understand, we have two distinguished members of the Institute for Law and Economics, Roy Katzevig and Isaac Corey, who are affiliated with investment funds. What's interesting to hear is they weren't just stockholders of one company. I mean, we were talking about a letter that said U.S. shareholders hold more than 40% of Cadbury's shares. I just heard two very smart friends of ours mostly talk about how they thought this was really cool for Kraft. And I believe, Isaac, you said even though you peaked at,
3% of Cadbury.
you were long.
We weren't hedging. We were still under. We were long. We were creating Kraft exposure to that.
Right.
I mean, we didn't short the Kraft that we should have shorted against our Cadbury just like we all.
Right, but you were looking at it as much from what was good for Kraft, from a Kraft perspective. And so this is the complication, students, right? Is Roy and Isaac are looking at they're investors. They can look at what maximizes their portfolio, and And they're not just focused on the best interest of Cadbury, but on how they make the most money for their investors out of this combined situation. But I take it, Creighton, part of what you're trying to do is, you want U.S. investors own more than 40% of you. You now got to jump through some U.S. disclosure. And
Yeah, it was really U.S.
hurdles.
disclosure driven. If you own more than 40%, you have to comply basically 100% with some limited exceptions with the U.S.
And so it
the
was
U.S. rule. So
it was nice to Sarah from a Clifford Chance, billing perspective, right? Because there were additional disclosure documents to be drafted, but from a Cadbury perspective, maybe not so good.
It would have been, except that we ended up still within Tier 2 in the end.
Okay.
So.
Yeah, it was. I think it probably ruined some poor associates' Thanksgiving weekend as the net result of it.
Heck, that's part of the fun for those of you who've gotten through it, right?
So on the 18th of November, Hershey and Ferrero Rocher, a European chocolate company, for those that don't know, publicly confirmed that they were reviewing a possible bid, presumably in response to a request from the Takeover panel. 25th of November, we start to see hedge funds shareholders publicly pushing Kraft to accept.
Were any of them ones who were actually long Kraft?
Don't know.
Do we know? Well, what's interesting in light of this colloquy we just had is that there's an indication here of hedge funds writing a letter urging Cadbury to accept Kraft's bid. I know, I was just inquiring whether anyone long Kraft might want to have urged Cadbury to take Kraft's bid before it was raised.
But Isaac, were you?
No one would. That would be pretty. Because that would be pretty brazen, I take it, right? Okay.
That's what I was going to ask, whether it was a pure arb transaction in terms of the relative prices of the two. As
It wasn't simply a bet on a closing valuation gap. I mean, it was partially that we thought that that this is a premier asset with where you should have seen multiple bidders, and it was surprising to us ultimately that no one else really came with an offer other than Kraft. Well, I guess Kraft was pretty confident about that, and we also thought the transaction made a lot of sense from Kraft's perspective, just to give some extra to that, because I think what Robert believed, Kraft has a phenomenal emerging market distribution platform. I'm sorry, Cadbury did, and Kraft had nothing. And sort of the idea that you could sort of begin to push Kraft's products to that distribution platform was a very, very attractive proposition for investors. So it was, kind of, from an economic perspective, the transaction seemed pretty attractive.
Question of Sarah's point about the takeover panel requiring the other potential bidders to disclose them. Is that in the takeover code? If someone what's the nexus that would cause one to
Yeah,
disclose?
there is a requirement in the code that, there is a requirement that you may have to disclose. In some ways, I was surprised. I don't know whether this was voluntary or not, because the panel might take the view, well, I can't remember if the document had even been posted at that stage. And I seem to remember discussing it when I was there, that if no document had been posted, we might leave it for a bit, because what does it matter at that stage? But at some stage, there would have to...
Is it looking at data information? What do you have to do to be forced to disclose? I'm thinking about it.
It would have been the level of speculation in the press.
Yeah, that was my recollection. Is it was.
And what was it
leaking.
forced? Do you know?
Well, I don't know if it was forced. Creighton might know, but
There would come a time when it would have to be announced, but early on, I think there is less pressure because the document hasn't been posted. Shareholders have nothing to accept at that stage. So what does it matter if somebody else is saying, "Oh, I'm thinking I might make a bid"? Once you get to day 21, the normal first closing date, or day 46, the final offer, by that stage, yes, you'd expect everyone to have clarified.
And the reason I think it probably was required is because the form of the announcement, it was a classic 2.4 boring 2 lines, just, oh, we got to do it, so we just put out what the bare minimum.
Yeah, that's my recollection as well, as it was a speculation, and the panel stepped in and required the disclosure.
Disclosure of what? Just so, I mean, I've lost the thread a little.
A potential interest in a transaction
Disclosure, by whom?
by Hershey and Ferrero
Okay,
Rocher.
so that what kids, just so the students know, you're saying there is this perception out there that if a so-called white knight comes and makes an approach, you've got to actually tell the markets about it.
There's no automatic requirement to do that, only if there's rumor or speculation and the panel feels that the market needs to have clarification.
So in the U.S. it would always have to be disclosed because there's always rumors and speculation, right?
Yes, that will
And
be
we're gonna
one of
get
them,
to
and
that.
we're going to get to
Slightly
get to
different.
those, slightly related. So on the 4th of December, we actually posted the UK offer document. So this is, when did we first start? We made an announcement on the 7th of December. We didn't post the offer document until the 4th of December. And that is D-Day from the code's point of view, and the formal offer timetable starts to run. And Noel mentioned day 21 and day 46. The code has certain drop-dead dates. And, but the only one really worth mentioning is that day 46 is the last day on which a bidder can revise its offer, and day 60 is the drop-dead date. Either you've satisfied your conditions or you haven't. So the posting of the offer document is a key date which starts the offer timetable running. On the 14th of December, Cadbury put out its defence document, and before Creighton talks about that, their document was beautiful and really compelling and looked great. Ours was pretty standard and looked quite dull. But I think that
one of the things you learn when you do a UK takeover bid is that you will spend months honing your takeover defense document, which is really just a hearts and minds document, and is, it argues the merits of the deal, but it will go through hundreds and hundreds of drafts. And as Sarah said, it looks quite professional in terms of its presentation. What was interesting from a technical U.S. lawyer perspective, which probably doesn't interest very many of you, is that for the first time we basically just took that document and then cross-referenced into it to satisfy the U.S. disclosure requirements. And when we did that and we sent it in to the SEC, the response back was, what is this? Where's your 14D9? This can't possibly comply. And we then walked them through it, and we ticked every box in the disclosure, and in fact convinced the SEC that the requirements to be able to make statements in the UK is so much higher than it is in the US. Everything has to be verified. Every statement you make, you have to verify it at the satisfaction of the panel. So from a U.S. perspective, it was almost overload from the SEC's point of view in terms of the backup that we were able to provide to them because of the rigorousness of the UK process.
Skipping down to the bottom, on the 19th of December, Todd Stitzer intimated a preference for a transaction with Hershey, which was, as Clayton can say, was a big oops from our side. We all tittered a bit.
It was misunderstood or misquoted or taken out of context. Well, any one of those three.
But Cadbury was required to make a clarificatory statement, right?
That's correct.
So what did he really mean?
I think he was a U.S. CEO of a UK company, and in an unguarded moment, made a comment that wasn't quite as precise as it could have been.
So we get to the end game.
So he meant it.
Yes.
We get to the end game. Timetable's running. Get to the 5th of January. This is the first possible closing date under the offer. Kraft increased the cash portion of its offer, reduced the share portion, but leaving the overall price unchanged. Agreed to sell the pizza business to Nestle. And any questions about Nestle, I'm happy to take.
Well, what was the motivation?
Well, I'm happy to have that opportunity to say that. If
It was lousy
think that
pizza.
I think if Nestle had really wanted to buy Cadbury, they wouldn't have been fobbed off with buying the pizza business for $3 billion. It was a great deal. It was a good price for Kraft, and they wanted to do it. It happened to coincide with the timing. They didn't as we talked earlier about certain funds, Kraft didn't need the money to make the purchase because it had to have certain funds at the time it made the offer. It did, potentially release some cash, obviously, that could be applied later on down the line. But in terms of a view that it bought off Nestle, I don't think that that's true. We talked.
We have a question over here. Yeah, what was the pizza business? I mean, which kind of these are students, right? They occasionally they stick in some god-awful thing into a microwave.
Was it Pizza Hut?
Yes, it was frozen pizza.
That's right.
The student wants to know which one, like Del Giorno.
I can't remember. I can't remember.
Tombstone, right? Yeah. Southwestern pizza.
With Warren Buffett's second announcement, we've already talked about. 6th of January, Kraft announced an acceptance level of 1.52%. You might query why Kraft would bother to announce such a low-level acceptance. That was a requirement of the code. Looks terrible, but in reality, in most hostile bid situations, you wouldn't have expected them to have got any more than that.
Usually described as derisory, I think.
Yeah. And in fact, before it went up, it went down, I think, as people then sort of withdrew at certain points. 8th of Jan, Cadbury announced informal talks with Hershey.
Yeah, I mean, the Hershey discussions were, we didn't put a high likelihood of success on the Hershey discussions simply because, for people who have followed Hershey, it's had a tortured history on takeover discussions because it's controlled by a trust. And the trust has a certain defined mission in terms of what it's supposed to be accomplishing with the Hershey Town and Foundation and everything else. So it was a little bit of a long shot. It was a consortium bid with private equity. Ultimately, to our surprise, the trust itself was supportive. The independent directors on the Hershey board, who were separately represented and separate financial advisors, were not supportive, and we just couldn't. They couldn't get their house in order in adequate time to really put a proposal on the table.
Let me just mention that in terms of class discussions of different legal regimes and companies' attachments to towns, there is nothing quite like Hershey in Pennsylvania. Milton Hershey grew up pretty much where he established his factory to make Hershey's, and part of the foundation's mission is to continue in the traditions that he had set out. And they are not looking to become a global power outside of Hershey, Pennsylvania.
They tried in 2002, right, and that was blocked by the Court of Common Pleas, and then by, and they walked away from Creighton. Mm-hmm. That became the mantra after
Yes.
not much was Bill Hershey who was the win of the Chancery Court settlement.
So Creighton, you
No, that would have been perfect because you would have had, if you put Hershey and Cadbury together, you have two chocolate companies, neither of whom actually sell chocolate products. They simply sell white sugar and milk.
So Creighton, what if you had been, if this had been a U.S. situation, you would have gone in front of Leo and said, you give me another couple of months so that Hershey can get its act together. Why didn't you go to Noel's successors and say, cut us some slack, give us some more time? The Hershey trust and structure needs more time, and that'll deliver more value to shareholders.
Yeah, you really don't, and Sarah and Noel could probably talk more knowledgeably about this. You really don't have that flexibility in the UK as you do in the US. One of the stark differences between the UK and the US is US you can drag out a takeover almost indefinitely, and in the case of Airgas, indefinitely. And the target and the target board, controls that. Ultimately, the shareholders can kick the bums out, right? Replace the board, and maybe cause something to happen. In the UK, it's a very strict timetable, and you need to live within that time frame. And that can work to your advantage or disadvantage depending on any.
But when you,
circumstance.
we talked about this at the beginning, when you invoked the put up or shut up, you believed it was not going to impair you. The chronology is really odd here in the sense that on January 14th, the trust approves a bid. And the day after, it all fell apart?
Yes, and the dynamic, in this particular circumstance, you could argue that the timetable worked against us a little bit, although I think, frankly, probably not, because I don't think they would have gotten there ultimately. And they had been, at the table and then away from the table, a number of times over the course of several months. And this was just the timetable, in fact, crystallized a decision time frame for them, and they ultimately made their decision and didn't step up to the plate. But it wasn't a question of not being able to.
Right before Kraft's bid, it turns out I think it was unrelated, but several directors from Hershey resigned, and part of it was the trust had gone to a certain control over the question of M&A. From the outside looked to us like Hershey was considering a bid for Cadbury or some combination of Cadbury.
Hershey and Cadbury had on and off discussions for years, right? When you think about a logical combination, Hershey has the Cadbury license in the U.S., sells an entirely different quality candy bar in the U.S., so from a Cadbury perspective, from a franchise perspective, being able to get control of that, the license again.
You and I are not going to be able to get back to London with comments like that.
Yeah. Cadbury really wanted to make that combination happen because they could have, influenced their brand in the U.S. and it would have been pretty compelling. But they could never get there because of the trust issues. And it was just a very complicated, dynamic at the board level. And you're right, when they stepped off the board, there was some background noise going on there about whether or not that might, from our perspective, from Cadbury's perspective, facilitate a deal. There wasn't any particular discussion going on right at that moment, but I think it was just a question of a culmination of years of conflict in that board that, ultimately resulted in that turnover on the board.
What happened to the other, was it Rocher? Who was the other chocolate bidder?
There's Ferraro.
What happened to that?
They were a private company, and they ultimately decided they just didn't want to take this big a bite.
And Noel, why is it that when a target comes to the panel and says, timetable is collapsing, we actually thought we didn't want to be under siege, we actually thought at the start of this that speed was our friend, oh my gosh, we're about to be sold, and we think we might be able to get some more money. Why wouldn't the panel intervene and give some time?
I'm not going to rely on the rules because there is a lot of attraction in listening to people's arguments about this, and so I can see that the panel would have said, say Cadbury Hershey had come to the panel and said, look, we're there or thereabouts, it's going to take beyond whatever the normal final closing date is, day 60 of the bid. What can we do? Now, I can think of cases where second bids have come in, but what happens when it doesn't quite come in? Normally, I think the panel would say, hang on, we think shareholders want certainty. Now, let's assume that the panel said there is going to be no extension whatsoever. You've got to get your act together before day 60, or people might accept the Kraft offer. The question is, I suppose, how much information is going to be out in the public domain about what's going on in the Hershey-Cadbury discussions? Because if people think there is something that might happen here, then maybe they won't accept the Kraft offer. Kraft themselves might come along and say, well, hang on, we need some clarity. We need an announcement from Hershey one way or the other. So there are all sorts of dynamics here, and whichever decision the panel came down with, if they were to come down with a decision, let's assume they said, sorry, it's day 60, it's day 60, it's day 60, you're either in the ring competing or you're not. Then that decision of the executive is always open to appeal to the hearings committee, which will try and hear that incredibly quickly and listen to, again, the arguments from all three parties and may say, we think this is perfectly legitimate. We think there is an argument that there could be some sort of extension. Rule 31.6, the rule that deals with day 60, does say that it can be extended at the behest, not quite that, of the offeree company. If the offeree company comes to the panel and says, look, we think day 60 should be extended for these particular reasons, it is open to the panel. I think we talked about the flexibility of the panel. This can be done. What they wouldn't like to do, going back to 1986, Argyle and Guinness going for distillers, my history is littered with chocolate companies and drinks companies. There were two competing bids in the ring at the time, and the offeree said, look, we want an extension. And we said, for what purpose? Because you've got two bids, with the final offer on the table, shareholders are either going to accept or they're not. If you end up with 40% of both, fine, we're faced with a different situation, but there's no point in just extending for a week and still having 40% voting each way in a week's time. But the situation here, I think, is slightly different. I'm not saying I think the panel would grant an extension immediately, but I think it is the sort of argument that they would love to hear. It's not built into the book. We run two different systems. I mean, as we have mentioned already, siege is vital in the panel's concept of takeover regulation. Siege can, of course, be waived by the offeree company. If the offeree company doesn't feel it's under siege, there is no siege. So that's another argument for saying, well, maybe they would have extended in some way. Personally, it's to say, I think I doubt it. But on appeal, and the hearings committee, there are shareholder representatives, company representatives, bankers. You've got a peer group of practitioners and shareholders who will decide what they think is best in those particular circumstances. It could have gone to appeal. It could have been passed.
I mean, I think it's accurate to say that if we, because we certainly had these discussions as to whether or not we might come to this circumstance where we weren't quite there, but it looked, very, very promising. But that our understanding was that it was a high hurdle to get an extension, and at that point, it was clear that the Hershey bid had really fallen apart.
No, and that's what I was going to ask, is we should kind of come to the denouement of the deal and then get into the policy reaction and some of the public reaction. Creighton, when Hershey goes away, you're in the non-frustration regime. You're pretty much at it. You've got the other bid is gone. Who owns your shares at that point, and how has it changed, and sort of how did the finale come to be? But if you could talk a little bit, because we're going to pick that up when your chairman gives his big speech, right? How had the stockholder profile changed during the course of the bid? And by the time you get to Hershey breaking up, who actually owns Cadbury shares?
Yeah, well, 2 points, I think, on that. One, obviously, there are a lot of short-term shareholders, and we can talk a little bit about that. But increasingly in the UK, which I think is an evolution really that has come more lately to the UK than has traditionally been the case in the US, where Arps were quite prominent, as going back to the 80s, really, in some of these takeover battles. In the UK, shareholders, I think, have tended to stick with the companies longer and more, and in fact, you get to end of takeovers, there tends to be a higher percentage of long-term shareholders. That has really, I think, eroded over the last, I'm not sure what the time frame is, but I think that the Arb community has gotten more active, the short-term owners are more active. So all they're interested in doing is...
Before the bid, do you have some sense of the rough percentage of your shares that were owned by UK institutional investors versus US institutional investors, and the types of institutions versus what the mix was when you got to this January period wherein Hershey goes away?
Well, it's certainly heavily institution. Obviously it's in the UK, there are a limited number of public companies available to invest in. So the UK institutions, and a lot of them have requirements to invest in London-listed UK companies. So it was quite a heavily weighted that way. Having said that, whether it was 40% or 39% or 41%, the U.S. shareholder base was quite prominent for some historical reasons in terms of acquisitions that have been done and so on.
Well, and typically what happens in the U.S. is that mutual funds, institutions like that, who are quite happy to lock in a substantial premium. If you're a portfolio manager and you got a quarter coming up and you can get an issue, you know, I can get this premium for sure. I can always buy back in some later on, but I can sell that. There's a lot of turnover into people who play the margins of this game. And did the UK kind of mainstream institutions essentially behave like the U.S. mainstream institutions? And was that a surprise to the people you were working with as your clients?
I think they did. I think not quite as much as you would see in a U.S. takeover, but still the turnover is quite significant among UK shareholders. The other dynamic when we came to the end of the game was that, you know, one of the things obviously that was going on a regular basis was Kraft was talking to Cadbury shareholders. Cadbury was talking to Cadbury shareholders, and ultimately they're coalesced around a number that Kraft was hearing back from Cadbury shareholders that it would take to get the requisite tender into the tender, and Cadbury was hearing what it wanted to hear about that, and they ended up closing the gap in a final negotiation. But that was really the ultimate determining factor, was what's it going to take from Kraft's perspective to hit that hurdle and get the percentage they needed.
Question for Creighton. On the issue of the traditional long-term holders who perhaps had historically sort of kept with the company till the end of the offer versus selling out in advance to perhaps the arbitrage community, we'll just posit that for the purpose of this question. Was there any belief on the Cadbury side that the folks who had sold out in the market at a lower price than the bid price would not also just eventually tender into the offer at a higher price later on?
You're raising a very good point, because one of the things we'll talk about a little later is this whole short-term shareholder argument, which has come up in the UK as a political matter as much as anything else, as whether short-termism has taken over from long-term holders. What that loses sight of is that those long-term holders have voted with their feet. They have sold. And they've sold to the short-term shareholders, and they've sold usually at a price below the offer price, sometimes above, but certainly below a number that they may be able to achieve if they stick through the end of the tender offer. But they want to lock in their gain for their shareholders. They don't want to take the risk that the deal doesn't happen, so they're willing to give up that margin, where the short-term holders might be less risk-averse and be prepared to jump in and try and turn the quick profit.
I would think also from just a portfolio perspective for an investor, once a deal is announced and it looks likely that it's going to go through, at that point, your short-term as well in the company, even if you've held it for 5 years, because you're going to be cashed out. There's going to be a deal one way or another. And I think a lot of people then trade, a lot of investors or holders will trade their stock because as a portfolio investor, they were holding a stock for a given purpose and how it fit in the portfolio. And once it's about to be taken over by another company, it doesn't have the same fit in their strategic view of what their portfolio should do for them.
And it may no longer fit their regulatory requirements, for their fund requirements as to, an investment that they can actually make. So.
Well, now we're going to go from the particular to some more highfalutin stuff coming out of this, which is sort of the political reaction, which was, I believe, fairly vociferous and not limited to the Labor Party, but the Tory Party as well. But we're going to put up some examples, just ponder them, of some of the public reaction to this.
Before you do that, the last thing on that slide was they sold the factory. Or they announced.
Yeah, maybe we ought to pause on that moment, inglorious moment.
Sarah was hoping you weren't going to ask that question.
We were going to get back to that for sure.
Slid right by that one.
So the offer was closed on the 2nd of February, and on the 9th of February, Kraft had to announce its decision to close the factory. And you might say that was, inglorious haste. To do it that quickly. I think that at the point at which Kraft had access to the information that enabled it to see that it was just not going to be practicable to keep that factory open, that was not until after the offer was closed. And at that point, Kraft thought, well, we need to put out the announcement as soon as possible. And that's why it came out so shortly after. But I think, as history shows it doesn't serve Kraft that well that the announcement went out from a publicity point of view so quickly.
But one of the situations there was, and I understood your CEO to say, one of the things she said was, during the course of the process, really the information sharing between the target and the bidder is much more limited, and there really wasn't an appreciation of how far along the closing decision was, and that like key equipment, I think your CEO said, had already gone to Poland and stuff like this. I mean, it was sort of odd, right? Because there's a credibility issue. You're a big company, and then saying, oh, by the way, we didn't know that like the gear shift went to Krakow.
Right, and I think that in moving the factory to Poland, Cadbury apparently ran an unusual parallel production process such that they had set machinery up in Poland already that was it was specifically to produce a certain chocolate bar, and that it was just not going to be practicable economically to move it back effectively.
Well, and you get this let's go to the political reaction, right? Because it's not just so it's not limited to the Labor Party.
And
right?
actually, just the last couple of slides is just to show that this is the entertaining headlines during the deal. But what's interesting about this is usually post-deal, it's all over. Nobody really bothers to comment anymore. But there was as much comment post-deal as there was prior to the deal, which really showed how politically this transaction had caught the attention here. And some of it you'll see. I'm sorry?
The offer that you actually posted, I think in the U.S., if a bidder makes a promise in a proxy statement, a hostile bidder might not have any information, might not know that they're not going to really want the factory being there. They're putting it to you, we're going to keep this factory, 10 euros per share, we may find ourselves in Vice Chancellor Strine. Did you promise to the
Come again, Casey. Right? Yeah, bring that time culture case. Let's protect it. Where is it now?
No, I mean, at the very beginning, I read the statement that was in the documentation, which said that Kraft believed, but essentially boiled down to Kraft believed that it might be in a position to keep the factory open. So it was very much qualified as a statement of belief. In well-publicized moment post the deal, the panel actually conducted an investigation into that statement and concluded that Kraft had made that statement genuinely and honestly. It was a statement of belief, but that perhaps the panel concluded that perhaps Kraft didn't have a reasonable basis to make that statement, and that even though it was a statement of belief, that Kraft maybe I don't know what Kraft could have done. I guess it could have not made the statement.
Well, and then there was also just, I don't know if we have a slide on it, there's a rather scathing parliamentary report in which an organ of the world's perhaps most longest lasting and respected legislative body basically publicly whines about Kraft making statements and bemoaning it and saying people should be lived to the world, but then in the end doesn't recommend any change in anything. But didn't people feel kind of ill-used, right? I mean, I'm assuming people felt...
Well, one of the phenomena, and Noel can be in a good position to comment on this, but in the UK market, if you say something in an offer document, and whether or not it's directly related to shareholder value or anything else, and it's inaccurate, there's almost a shaming concept that you just don't do it in the UK market, and there are potential consequences. So in this case, one of the bankers for Kraft was up to be the next head of the FSA, I believe.
No,
the
next
panel.
Director General of the
The
panel.
next Director General of the panel. Although there was never a direct tie into this issue, it became pretty clear that this particular issue and this particular statement derailed his being elevated into that position.
Actually, to be fair to Peter, he chose not to go.
Yeah.
That was his decision.
Yeah.
Well, and then we're going to come to, let's get right to Roger Carr. And I just want to get it, because I want to, and I don't let you in, Scott, but I want to friend this. One of the things that's most surprising about this is that this is at all a hoo-ha. Because as someone who's an American, and we had to listen to all the guff about how great the UK system is and non-frustration and
it is.
the EU should follow us. Okay, here comes a very credible bidder, fully financed, has a reputation, it frankly is an employer in the UK, pays its workers well, makes a bid. Big deal, stockholders should decide. And then there's this bipartisan uproar because everybody fondly remembers gumming on their dairy milk. And the target company had bought Schweppes and other things which were assets of other countries and in its history. The target board had offshored to Poland. What gives? You've been sticking it to us rhetorically for 25 years.
Just before the Brit bashing, just one question before the Brit, because I know Leo's been dying to get to this part.
Well, I've been hearing about the superiority of the system forever.
Just before we get to it, Creighton, this may not be a fair question. Did you think at the time that you recommended the bid, so you got to a price that Cadbury said, okay, we've got to go, did you debate trying to draw Kraft out in terms of a more legally binding commitment with respect to the facility, or was that really not part of?
No,
because it wouldn't be unheard of in terms of a hostile deal going friendly, especially in the context of the debate that was raging over, is this facility going to be kept open or is it going to be shut?
No, we didn't. In fact, there was a very heightened sensitivity on our side not to do anything that looked anything other than shareholder oriented. So that included, arrangements for the benefit of management and so on, that, they wanted to be crystal clear that it was, this was just shareholder value and no other issues.
Well, how about, why don't we go to Roger Carr then, and somebody talk about, because he's the chairman, right?
Can I just say something before that? I mean, I'm not going to respond, I hope, too much to the inflammatory statements you just made about the UK. I think as far as the city was concerned and the shareholders, this bid was boring, mundane. It was a typical hostile bid. You look at the things of interest. Somebody made a rash statement, happens from time to time. Shareholders in the end accepted, well, I don't know whether it was a generous bid or not. It was a bid where they agreed, because it is quite unusual when it's been contested all the way through, unless it's a real slam dunk of a bid, to recommend on day 46. You often, let the bid run a bit and say, oh God, yes, we have lost. So now's the time to recommend. We've seen day 58, day 59 recommendations, but unusual to see day 46. So I think in terms of the panel and its operations, this was just routine. Why it raised such political concern, I don't really know, to be quite honest. I mean, yes, it was an election year that year, I think.
Mm-hmm. And was it real concern, or was it mostly posturing?
Well, I don't know. Roger Carr has been on both sides of bids. He used to run Williams Holdings back in the 80s, I think it was, which was very aggressive, took over a lot of companies. And you might say, was this his first time on the defense? I don't know whether it was or it wasn't. I was concerned that all this fuss was being raised about a company which I think has the vast majority of its employees abroad, the vast majority of its almost 50% of its shareholders abroad. I couldn't see what the UK concern was. Mark Uy said the same back in the 90s when two Swiss chocolate companies bid for Roundtree, another Quaker chocolate family. And questions were asked in Parliament about why this was going on. The Takeover panel should stop it. And we don't stop bids. It's not our role to be defenders of the public interest at all. So I think the city, by and large, will have seen this as just another bid. The politicians, I don't know whether there were votes in it or not. It does happen from time to time. The politicians pop up and say they don't like short-termism, they don't like this, they don't like the other. 1989, there was a report by Lord Rockley, it was before we had a code committee, about whether there should be changes to rules. Short-termism crops up there. The 50% acceptance threshold crops up there. These things, you know, come in their own time, several times it appears. But you know, the system of regulation of the bid itself, I think, worked well.
Well, no, and my only point, Noel, was given the long-standing existence of the non-frustration rule, this is mundane, as you said.
Well, non-frustration has nothing to do with it.
Well, right, but that's what's interesting from an American perspective, which is this is the natural outcome of the long-standing British system. And to hear, it wasn't just Carr, the new Tory government has asked, right? I forget how you call it.
Well, I think you'll find that what the Tory government's asking for is not going to have much impact on the takeover panel at all.
I didn't say that, but I mean, I don't know. I guess as an outsider, I refuse to not take your government seriously. That's a prerogative more of a citizen than a non-citizen, and the Cameron government, right, the relevant secretary, has called for an inquiry. And just, do we have the Carr thing up there? You know,
we have Carr.
These are the recommendations to essentially raise the, you know, we would call it in the U.S. the tender offer acceptance thing to some sort of supermajority, to have essentially a weird form of time-weighted voting, right? But it would be more extreme. If you bought shares during the bid, you would essentially not have a vote, right?
Yeah, the government's consultation paper says the three things up here: whether short-termism is a problem, whether shareholders of an acquiring company should always be invited to vote on takeover bids, and that goes back to disenfranchising shares acquired during a bid, or raising acceptance level to higher than 50%.
But Noel Hinton is really happy right now.
I met with Carr umpteen times during this proposal, and this was never the subject of conversation. He was always articulately projecting himself as the most, you know, who's the shareholder today, I'm friendly to you, type of chairman. It was kind of interesting just to see him, the bold face that he did. The second thing is, I'm a long-term shareholder there, guys. I've been there for over a year.
And you've been stuck.
I guess you're staying.
Actually, you've actually made money. But, you know, I'm a little bit baffled. You guys, we bought this stock from someone, right? And, you know, circumstances made them make a decision they made. Who's short-term and who's long-term? I think this big long-term shareholder. I mean, there's a forced investor, who's the American worker who's got a pension fund invested in the S&P 500. Right? He's not long-term shareholder. He doesn't have a choice. He's not making a choice. And then there's other people who are short, you know, kind of just, they're price sensitive. And this is all a question of where things are priced. But if they take away the vote from the shareholders, it just means that the long-term shareholders, the incumbent shareholders, will sell at a lower price to the arbitrageurs because the arbitrageurs have less control of what happens.
No, and I think, I just want to be clear, I'm not making a comparative point, Richard, about which system is better. What I do think is more notable is what you just said, right, which is this is exactly how you would have thought this dynamic would have come out under long-established UK rules. I suppose what we can say is this is all just illusory and that this doesn't reflect any real concern, but I'm assuming there must have been from both the Tory and the Labour side, enough view that there was some discontent among the British public that people actually had to go through the motions of considering this? Or is that, you know, there is a why bother. There are things where you wouldn't have both parties react. Is what you're saying, is everybody on the thing panel just agree? There's nothing going to change in the UK?
Well, I certainly agree. I've got the panel response to its original consultation in front of me about disenfranchising. Why don't I read out just a sentence or two from that? And very unusually, there are, I think, 97 respondents to this paper. To be quite honest, there are times you can count the respondents on the fingers of one hand. The people who are interested, if they think it's fine, they tend not to respond. So here, disenfranchising shares acquired during the offer period. The respondents were almost unanimously opposed to disenfranchising shares acquired during the offer period, and also to the introduction of a qualifying period prior to shares carrying votes. The majority of respondents were of the view that each of these proposals would compromise the principle of one share, one vote. And that is something which I think UK shareholders generally have finally managed to achieve. They've by and large got rid of heavy voting shares and so on. So it is one share, one vote. And if you buy a share, you should be entitled to vote it. Certainly I know when I was at the panel, there was absolutely no question, despite the odd complaint about short-termism. We said, look, if someone's bought the shares, they've bought the votes. They're entitled to exercise them as they choose. So the panel has no complaints about it at all. And I think the vast majority of respondents feel the same. So I don't think there will be a change.
Although to place, I mean, I totally agree, but to play slightly devil's advocate, the vast majority of respondents are those who operate under the existing code of financial institutions or lawyers, deal makers, deal doers. The takeover panel in this way is completely different from the government. The government may take a different view. I think it's unlikely, but as the panel says, the question of raising acceptance conditions or disenfranchising shares is really a policy one for government, not for the takeover panel. So it is possible that the government will put out some new legislation or proposed legislation in April that addresses these things.
Well, let me put it straight, because Richard raises an interesting point. Air gas is obviously in the air, you know. It's arguably a very redundant name, air gas, but it's an interesting situation, obviously, and but one of the things that the panel's doing, and we talk about, is the deal environment in the U.S. and how deals get done is so much different than in the U.K., which is you can't, if you get due diligence, everybody else in the world is going to get it without signing a confidentiality stip, without proving their bona fides. So that makes, if you go in and you do a deal, you have to you either do it blind or you risk sharing with everybody. If you put yourself out there as a strategic, you can get at most now a 1% break fee, and it's my understanding that the takeover panel, in response to Carr, which is kind of interesting, is now going to say, oh, let's just get rid of all break fees altogether. So I'm a CEO of a company. I know if I make a strategic initiative and goes public and I don't get the target, that's kind of embarrassing. People like my friend Isaac and Roy, they may be thinking that, you know, people should be considering other strategic alternatives that I haven't put on the table. So maybe I just don't do that. And in the U.S., one of the ways where people like Isaac and Roy, and even, frankly, the mutual funds who represent, you know, have everybody else's money, because that's where you have to give them, one of the ways they've made out is two strategics get together because there can be some deal compensation. And that really creates a pressure for the other strategics to decide whether they're going to buy. And a lot of the hostile activity in the U.S. is topping bids. And there's a paper by a respected academic, former Wachter partner named John Coates. And John says, we ought to go to like UK-style break fees. It's all too complicated in the States. We shouldn't have people like Strine or former Vice Chancellor Lamb looking at reasonableness of deal protections. We should just go to the British system. And then at the back of it, Richard, is the statistics. And over a 20-year period, the UK system, stockholder Nirvana, compared to the U.S., in the U.S., statistically significant result, much higher incidence of premium-generating transactions.
The fundamental issue is in my view, the English model, all hostile M&A is a negotiation.
No, and what I'm saying is no, and that's what the issue is. And it maybe that's one where the panel talks about where you go in terms of the direction of what the panel seems to be, Noel and others, looking for giving targets more room to create auction dynamics or get a higher price. You can have a system where you can make an argument that in air gas, for example, stockholders are not getting their head. But you're looking at the value created from an overall system, and isn't there an argument, and the data that John Coates presents, that having a republic that is oriented towards stockholder value actually produces more value for stockholders than having a direct democracy oriented towards stockholder value. That they're both oriented in the same direction, they get there a different way, each has its costs, but that there's some real benefit in terms of how many transactions you get that create value from the U.S. approach rather than the U.K. approach where, frankly, no one wants to come out of their tortoiseshell. So I throw that out there. Scott, you've been on both sides of the pond.
Yeah, I listened. We had a discussion that Leo participated in with the panel during their consideration of some of these, some of the consultation that they're going through, and Leo was quite brutal in his assault on the position that break fees should be eliminated, and that was somehow an important part of helping to protect targets. And Leo's sort of quite strident, as we just heard about, the significance of break fees in terms of driving shareholder value. I must admit, I'm not necessarily persuaded. The UK has had 1% break fees, which I don't think really is that meaningful to a lot of bidders, and so I don't see break fees as a determinant, as a fundamentally important part of the process, and I think that's what the panels had been on a jihad to eliminate break fees ever since they let it creep into the process, and now this is their moment to take.
But what I'm talking about, Scott, you represent people who do deals. In the U.S. environment, I think, as Richard said, there's a thing where the target has leverage through its board. By boards having leverage, there's an incentive for two leaders of two corporations to get together and put together deals, because there can be some protection, there's some ability to talk without putting yourself out there. There's some compensation if somebody else gets it. And what the Coates paper shows is that the incidence, right, of premium generating M&A activity has been consistently higher in the U.S. system than in the U.K. system. And I'm wondering whether that has something to do with the access to due diligence, the ability to shape some deal protections that's absent in this. And you've been on both sides of this.
Yeah, it may. I mean, I think the emphasis should, in terms of reviewing the U.K. system, as I sort of signaled before, and Noel quite rightly said, the existing rules have the flexibility on the part of the target to go to the panel and ask for more time. I think the reality is that, at least historically, there haven't been many examples of extended timetables to give targets a lot of time. I think where they're headed, and one of the things they're looking at, is whether more flexibility should be given to targets, which brings the model a little closer to the U.S., whether a little bit more freedom and flexibility ought to be given to targets once and if they've decided to launch an auction. And I think that would begin to, potentially add significant value in these transactions.
Well, and one of the things that we talked about with the panel, it'd be interesting to get everybody's perspective, the audiences, when we were talking about an auction, say you got down to 2 or 3 bidders, how did you get anybody to actually, it's already hard in the U.S. system, right, to close an auction, to know that you should be putting your best price on the table. How do you do it in a regime where they were trying to create an auction where they were going to take away even the ability to give a 1% break fee? What I was trying to figure out was, what was it you were giving, and I'd be interested in you guys' perspective from the UK, how do you actually close an auction if the winner of the auction gets what? What do you get?
Just to go back to break fees and their introduction in the first place, when they were imported from the US, I have to say there was a lot of outrage from all our constituents, with the exception perhaps of the offerors, about value being taken out of the target company. We, as the panel, didn't have a great feel for this, whether we should stop it or not, because we felt, well, if this is the way that M&A is going, why should we stop it? But we were getting incredibly strong feedback saying, don't do this. And we thought, well, maybe we should allow it. Let's suck it and see. And I think we agreed then it's at the 1% level, because we thought that isn't a lot. I don't know whether that means it's not worthwhile. It's another thing, but they have become pretty standard. But it is worth saying that if there are going to be 2 or 3 bidders, we allow them all to have 1%. But the listing authorities, I think, then limited the expenditure on these sort of fees to 1%, unless I'm mistaken. That wasn't the panel, that was the listing authorities. Now, I don't have a feel for whether this is good or bad, because I don't have enough exposure to the American system. But I was at a conference a few years ago in New York when I was told break fees were, in the financial sector, were hitting 5% plus.
Bank deals are special.
Well, of course they are.
They're
yes.
bondage
but
deals.
if there's someone competing where there's a break fee of 5%, I mean, my simple look at it is if I offer 100, I'm only going to get 95.
But I think, Noel, what the issue is, and this is,
sorry to interrupt you, but my train of thought was, and I think this is why there's a sort of an antipathy to them in the UK. And I think all of this, we're looking at the potential termination of implementation agreements as well. I've been trying to figure out this, because I think when we had our little chat, not the one at half-time, but the earlier one, I was surprised that they were going for this, and I do wonder whether it's the axis that they've been given at the moment is there's too much scope for offerors, swing the pendulum back towards offerees, and I was just wondering whether what they're trying to do is clear the clutter away, because there was a time when you announced an offer, you made an offer, you either won or lost, and now we've got. I hate to think how long some of these implementation agreements are. I think maybe the panel is saying, look, if you want to offer for the company, fine, but that's all you're going to do. Just go ahead and offer for the company, and shareholders will decide whether or not to accept.
Well, no, and I think that's what's confusing, because I think there is a difficulty, right? There's a tendency, and I'm joking about the bank fees. I used to actually compare them to members of British cabinets, because for a while there was always somebody being found in a closet or something, but bank deals bound each other, right? The bank, why? Oh, it's a bank deal. So we were like in shackles, and you had these weird images. And actually, there's a partner at Wachter, all of his deals were bound. But we have to police these, and then there's cases from Chancery saying that's unreasonable. But where you get, Noel, and what I'm confused about is the panel's interested in auctions. Where higher break fees have been used, I think, in the way that gives courts the most assurance that they make sense, is in the context of some sort of auction, where you have 2 or 3 people competing, and you're saying to the one who wins, if you get the highest price, there is going to be a buffer. There's going to be something like 4% plus match rights plus no shop, precisely to get the 3 bidders to really pull out their price. What the panel seems to be talking about, and I'd be interested in U.S. practitioners how you would do this, is to create an auction dynamic where the winner of the auction gets nothing, and where anybody else who came in second and third the next day can just simply announce a new bid. It seems to be like a different regime, whereas what you're saying, Noel, is, which makes sense to me, is that's just not our system. We're not worried about auctions. You make your offer, the stockholders accept it or not, and you move on. But the panel seems to be kind of wanting to have a U.S. aspect of this in a situation where the seller doesn't have any tools to give to the winner.
Well, I confess, I don't know where the panel thinking is on that, because obviously I wasn't privy to that discussion. I was just thinking I have been present at 1 or 2 auctions. One of the steel companies, we had an Indian and a Brazilian bidder, I think, and we decide, yes. Yeah, and what we did, 2 bids, we need to resolve it, we need a final bidder, and we were there overnight. We gave each side an hour to up the bids, and I can't remember whether they gave them both an hour at the end, and the highest bid won. And that was an auction in a truer sense in some ways. You know, the best bidder wins. What I can't remember, and I don't think it applied in that case, thankfully, is how do you decide which is the better bid, equity or cash? Because that's clearly going to be a problem.
Well, what happens? Well, how would you think it would work, Casey? I mean,
Well, I mean, I think it's an anachronism. I think this was a big deal because it was a time, they should have merger agreements, they should have certainty. I mean, the real question is when, you know, should there be an EU-wide system?
Sorry, an EU-wide system for, well, in theory,
They tried that.
there
with
is
the takeover
the
directive.
takeover directive. I was fortunate, is perhaps the right word, but maybe not, to be present at quite a lot of the meetings on how this directive was going to be adopted. And I do remember a senior civil servant from one country saying, the problem with directives is you end up with the lowest common denominator. And that is absolutely true of this directive, which I don't think is particularly well written. Leo, no doubt, thinks it's very Anglophile. Well, perhaps because...
No, I think because most people have taken exceptions from it, it's not at all Anglo.
Well, the reason for the exceptions is that obviously a lot of people do feel there should be no frustrating rule at all. But when we started with 12 member states back in 1989, there were... France had takeover regulation, the UK had takeover regulation, the Netherlands had embryonic takeover regulation. 85% of the bids were taking place in the UK. So inevitably, we were in a fortunate position for trying to argue about what we felt should be in the directive. But has it led to harmonisation? No, in a word.
Richard, how do you think you'd run an auction under this system? Could you do it?
No, you can't. But what you heard from Noel very politely is that the English model is heading in the direction of you put your number out to the shareholders, and that's the only thing that matters. Going back to my characterization of it, if you're conducting a negotiation between the acquirer and the disparate target shareholders, the only thing you can negotiate over is price. It's too hard to engage in sophisticated negotiation of trading price offerings, deal certainty, or anything like that. So what the takeover code does, and it consistently eliminates any scope for negotiation on anything other than price, and encourages that way people to put the number on the table and put it on limits. If you were to ask me actually, what's the negotiating leverage you need to give to English target boards to maximize value for shareholders, I wouldn't say break things. I'd say negotiate conditions. Ditch certain funds, and that's private equity funds, Woods in the United Kingdom, use financing condition deals, watch the premium drop, and then one deal in 100 will just go spectacularly south. People will wring their hands about whether the law's right. But it's all part of the same thing. Taking away the ability for the board of directors to negotiate the things that we negotiate, and hopefully the things we negotiate we extract value in the form of trading on pricing and other things. That's just not the intent.
I mean, the reality is there are no tools. You know, it's strictly hearts and minds. So you eliminate the upfront piece, which is the board having a seat at the table, and there's no poison pills, there's no takeover defenses, et cetera. So there's no reason for the bidder really to talk to the board. It's nice to have a recommended deal, but it's not necessary. So there's no leverage, there's no threat that a deal just won't happen unless you hit a certain price threshold, right? So as a result, there's every incentive to put in a relatively lower price, especially if you don't think you're going to have competition, and then just wait it out and then calibrate to what's going to take just to get to 51%, rather than having a strong negotiator on the other side of the table that can literally block. The whole argument over break fees, to me, is a tempest in a teapot because it's 1%. It's de minimis. It's completely meaningless. And I think all the other changes that have come up through this panel process are also quite meaningless. The only thing that I think has a marginal impact is the impact on the private equity firms of not having the 1% because they, for them, these transaction costs where the deal may not happen, if they go first and lose the deal, not having that 1%, can make some difference to them.
No, and that was I'm actually not, I believe Delaware is best. And so does Chief Justice Veazey and Vice Chancellor Lamb, and it is best. But I'm not critical of the UK system. I just think what was created cognitive dissonance about this deal was that it was so mundane. And what created cognitive dissonance, Noel, when I talked to the panel, Richard, was your point, talking to folks about creating an auction dynamic in a situation where the target board doesn't have any tools is just bizarre. And it's like your current system, it's not if you're fine with it, it may not actually be as good for stockholders as the messier U.S. system because of the fewer incidents of deals. It's a different system. But they seem to be creating, and then to get to the one proposal to just get rid of the 1% that you can give, but then somehow they really were interested, weren't they, Scott? They spent a lot of time with Scott and me about how can we give boards the chance to create an auction dynamic.
I think that,
and we were just asking them really. I was just kind of saying, how? I mean, what do you do, George?
I think the one area that they are thinking about. I'm not sure anything will come of it, but the one area where what they were interested in the discussion with you, Leo, is in a situation where a target board decides that it will be sold. And maybe it started through a hostile bid. In a situation where the target board says, we're going to be sold, we want to run an auction, we want to get the highest price, what should the panel do in terms of timetable and adjustments to the system to give some more flexibility to a target board, recognizing that it is a system that gives historically the boards no power? Should the panel be considering some changes? That's, I think, the only area where there's some pause. And we'll see. But by and large, the furor, the public furor, has not, and I don't think I don't think anybody on the panel here expects to see significant changes in the direction that the public debate would have indicated.
No, and in that way, the UK actually, Noel, will be quite an outlier from its EU partners, most of whom have actually deviated from the directive in fairly protectionist ways, haven't they?
I knew you were going to ask me that. And of course, as I say, when I was negotiating, it was very few countries. But yes, I think you're probably right. I think the majority will have opted out of Article 9. Right. Yeah.
Can you speak up? Just
one of the biggest cultural differences, yes, and it's who is your counterpart. In the U.S., if you're negotiating a merger, a friendly transaction, you're negotiating with the board because of the Delaware statutory requirements, right? If you want to go to the shareholders, you would go with the tender offer, but then you end up with the board having control of your defense mechanisms, right? In Europe, culturally, I think the
I think one of the dynamics, the political dynamics that I think, in addition to the iconic brand, is just on a comparative basis, the sense in the UK that, and this has been a point of pride, I think, on the UK side historically, and a point of principle, that it's the shareholders decide. The flip side of it is watching what's been going on the continent with national champions and so on. One of the jokes in the deal was that if Cadbury had been in France, we would have been a strategic asset of the country, like Danone was when rumors were surfacing about the Danone bid, and Kraft would have been warned away and wouldn't have done that deal. Or Aventus, exactly. So I think there is a comparative side to this. In a down economy, rightly or wrongly, there's a perception that you're taking away a UK asset and it's going to be run overseas and it'll be all, there won't be anything left on the UK side. Now, that may in fact not be true in reality because Cadbury really had moved a lot of its assets outside the UK, but there is certainly a perception in a tough economy that the takeover of UK manufacturing companies is not a good thing, and relative to what's going on in other countries, it's counter-cyclical in a way.
Can I just ask a question of Sarah, because I think one of the changes that is likely to come, so we've talked about break fees being eliminated, and but one of the changes that is likely to come is to shorten the put up or shut up period to a fixed 4-week period of time. What would have been the implication for the Kraft bid if you had faced a much shorter and fixed period as opposed to much longer and frankly one that could be negotiated and postured?
I think, as you'll see from this slide, the panel have suggested a number of things to address the concern that it was too easy for hostile offers to succeed, and one of those is to reduce the put up and shut up to 4 weeks. And that would be an automatic put up and shut up 4 weeks from announcement. So it wouldn't be at the request of the target board, it would automatically be 4 weeks. And I think certainly in the case of complex bids that involve different share offerings in different jurisdictions, complicated consideration, a lot of finance raising, I think that will make complicated deals and big deals very hard to do.
Do you think it make it hard to do, or just require a lot more work up front and more expense up front and payment of fees, et cetera?
I don't think it makes them impossible to do. It obviously means you have to front-end a lot more of the work. You're going to have the issues around that, though. The more you're doing, the more people you involve, the more people you try to talk to get ready, the greater the chances of a leak, which will put you in a put up and shut up quicker than you might even want to. Mm-hmm. So I don't think it's impossible. I just think it certainly will make it difficult.
Is part of that because, especially because if you have stockholder bases in different nations, even for a cash deal, the ability to get it done? Because I would think, Sarah, if you actually knew that was the rule, and you could get your financing together and make a pure cash bid, the target's ability to seek out anybody else in 4 weeks is basically nil, right?
Right, although
it doesn't
obviously
have to be within 4 weeks, though, because you've then got 28 days to post the offer document and 60
and then you've
days.
Got 60, yeah.
Okay.
So an interloper can come in at any time.
Just as a matter of course, let me mention that this rule, I think I said, came in 2004. I can't remember whether the papers, the consultation papers mentioned it, but back in 2003, an option was to go straight to a fixed 28-day period. It had been thought of at the time. And this rule originally saw the light of day 1989. Asher Edelman and Storehouse, he kept on muttering about making an offer, and eventually he was told to put up or shut up. And the rule didn't come in because we operated it with hardly anything in the book until about 2004, when it's up to the panel to decide how long the period should be. And I think over the years the period has been shortening, the period that the panel allows, and I think this is just the next stage. And I've seen that in other rules as well. There's no rule, a new tactic develops, the panel says, oh, we better think about this, put something in the book. and we will judge what we think is the appropriate amount of time, and then eventually we go to a fixed term. Rule 6 started off as very vague. If you bought shares when a bid was reasonably in contemplation. What does that mean? And after a while we realized that was a bit of a mistake and changed it to 3 months. So it simplifies the code in some ways, makes life tougher for bidders, but maybe it puts a premium on confidentiality.
Go ahead.
Doesn't the shorter period just naturally reduce the premiums? Harder to get the deal done, harder to get it financed in a short period of time, harder to get a topper to come in. At the end of the day, if you look at tender offers versus negotiated mergers, premiums are less. If you look at the result of poison pills, at the end of the day, premiums were bigger when people could exercise the poison pill. It didn't really eliminate the deal, created the opportunity to create value for the shareholder.
Yeah, but all you have to do in your 28 days is put up or shut up. If you put up, it doesn't have to be at your final price. You've then got 66 days to up the offer.
But you have to put up with certainty under your system.
Yeah.
Right.
Yeah.
Right.
Yeah, but there will be an exception. I am willing to bet a reasonable sized fortune that if the offeree company goes to the panel and says, look, we're so far down the track, it's all going swimmingly, can we have some more time? The panel will say yes. Because it's got back to the question of siege. If you and I are negotiating very successfully and think we can come to a deal in another 2 weeks, the panel's going to say, fine.
But Richard, your point was one that Scott and I both made to the panel, that we just couldn't get their directional impulse and their solutions seem to be, totally in tension. But this has been fascinating. I want to give each of the panelists quick, if there's some takeaway about the direction of things in the UK, some comparative point, if you want to make a brief point, it'd be great, and then we'll close this up, and some of us are going to adjourn, and we can continue the discussion.
Yeah, the discussion very much will continue over dinner, so don't feel it ends at this point.
Any last comments, Scott? And bash the U.S. a little bit?
No, I mean, I think
I won't tell Homeland Security.
I think the takeaway is that, notwithstanding the furor, if anything, some of these rules are actually going to get more streamlined. I think target companies will come out of this with less flexibility than they had. I accept that what Sarah said about put up or shut up being difficult for bidders, but unless targets are given some flexibility to extend the timetable, I think in the end, you don't see the increase in shareholder value that you could. That's not a universally held view. I think, in fact, most folks in the UK system would disagree with that.
And my takeaway, I think, is, I agree. I don't think we're going to be looking at a wholesale change in UK regulation. I personally think it's a shame that in a no frustration climate, the panel has sought to introduce rules like the shortening the put up and shut up, limited deal protection measures, which I think, in a system where you're supposed to be protecting and enhancing shareholder value, will actually make it more difficult for bids to be brought to shareholders for their consideration.
Yeah, I see that side of it, but I also think that at the end of the day, everything that's being proposed and considered and that's likely to be adopted is going to be very marginal in terms of any impact on the fundamental way deals are done in the UK and the fundamental difference between the US system and the UK system when it comes down to tactics.
I think we have two completely different systems. But I would say that the vast majority of offers in the UK are recommended. And so there is discussion between the parties beforehand to agree a price. The figures for hostile bids obviously varies from year to year. But I've been very interested in what has come out today, because I think I tend to agree with my personal rather than panel hat on, that I think there will have to be some sort of movement towards allowing a bit more flexibility to offeree companies to negotiate.
Well, these excellent slides that our panelists have been gracious enough to put together, we will make available to you all promptly tomorrow by email, and they really are good. And if we could thank our friends who came so far and really for a tremendous program, it'd be great. And those of us who are lucky enough will get to continue discussion. But if we could thank our panelists, we're very grateful.